What's up, guys? Welcome to Stock Talk with Nico Kritikos. We're testing out some new equipment here today with a new microphone and video camera. So let's see how this goes. Today, we are going to be talking about 3 things that you should always check for before you invest into a stock. So first one up on our list is going to be the share count of the company. So this is impacted by how many shares they issue. The reason a company issues shares could be for many different things. Could be to raise money for the company. It could be to, a lot of times when they hire new employees, they will give a stock-based compensation type of deal, and that will also increase the number of shares. Many companies, quality companies, will also do share buybacks. And with those companies buying shares off the market, that is going to lessen the number of shares, which means that it's going to increase the value of a single share. So in this case, we're going to use Starbucks as our example here. And if we go ahead and look at their share count over the last however many years, what we're going to find is that it's pretty consistent, right? If we go all the way back to 2004, 2005, it was about 1.5 billion shares. And today it's 1.1 billion shares. So over the course of that time, they've actually bought back a decent amount of shares, and that helps the stock price go up over that period of time. Then number 2 on our list is going to be the PE ratio. Now we have a trailing PE and then we have a forward PE. Trailing PE means you're using the ratio to look at the trailing 12 months of earnings relative to the current price. Forward PE means you're taking the price and you're dividing it by the company's expected earnings over the next 12 months. So most of the time, forward PE is more important because when you evaluate stock, you're looking at the future of the company's earnings, not so much the past, even though the past is not more important, but the past is important because it's a accurate number. The forward earnings is always going to be estimated. So, but what we're going to do with this is we're going to say, okay, we're going to compare the PE ratio of where it is today relative to where it's traded at in the past. And you can also use it to compare against its competitors. However, I think the best thing you can do with it is look at where has the stock traded at in the past. Now, usually, traditionally, a stock with a high PE ratio, if you're paying a high price for $1 of earnings, let's say, that means you're expecting that company to grow earnings a lot or faster than its peers in the stock market. That's why you would pay, let's say, 50 times earnings for a company instead of 10 times earnings, because the company that trades at 10 times earnings is not going to grow as much, most likely. And the company that trades at 50 times earnings means that investors are expecting that company to grow earnings fast. That's why they're willing to pay a lot more for a dollar of earnings, let's say. So Starbucks right now is trading at now this is trailing PE. Starbucks is trading at a trailing PE ratio of 37, which means 37 times last year's earnings. And if you look, we had this huge spike here in 2020, but that was like an outlier year. That shouldn't really even count. We're looking on a normal basis back from 2015 to now. The stock normally trades right around a 26, right? It's right around a 26. It could come down to a 14. It can go up to a 32. But right now at a 37, we are very much so on the higher side of things. So that's why I would not consider Starbucks a great buy at the moment. I think it's a great company. I actually bought the stock at about $75 and ended up selling around $95. But back around $75, $85 a share, I would say it's a good time to invest. But over $100 a share, I think you really got to be looking long term, because I think there's a good chance this stock comes back down under $100 once again. So number 3 on our list now is going to be the return on capital or return on invested capital history. And this one's kind of similar, where we want to look at what it did in the past and are they improving on it. And then we also want to use kind of like we want to have a standard for what is acceptable and what is a healthy number, because if the company is getting a 2% or 3% return on their money consistently, that's not good. A 2% return on your investment that's not what we want to see. Okay, that you're not going to get good returns with that company. That means they're not investing their money wisely. They're not going to be able to grow that fast and everything else. So if we use Starbucks, we can go down here to ratios and we can see return on capital employed, which is the same thing as return on invested capital. Now, what you can see is going all the way back, they've had, back here they had 8%, 5%, and then over time, they've gotten up to 11%, 10%, 8%, 7, 11, 12, 13. Then it came down a little bit to 5, 7, 7, 5, 6, right? So I would say that traditionally I like to look at, like, if it's like anywhere below, like, let's say 7%, let's say, if it's below 7% or 8%, that's not very good. We want to see return on invested capital of like 15% or like 25%. Now, if you look at companies like Microsoft, they have super high return on invested capital numbers. They have up to 25, 35, even 45 at some points, where they have those super high return on capital numbers. Now, so Starbucks at 5 or 6, 7%, not the best. It's really not that great, but it's consistent. And it's this is a company that we're pretty familiar with. They have a pretty strong brand. So this one's a little bit different, and plus they pay a dividend too. They pay a 2.5% dividend on top of this. So, and if you're invested in Starbucks, you shouldn't be expecting huge returns every year of 20 or 30% anyways. You should just be expecting 5 to 10% plus your dividend. So that's to be expected with a company like this. But that's also something you want to look out for, is if it's a newer company, let's say we're talking about Tesla, for example, or you're looking at a company that is in its earlier days, you want to see, are they improving that return on invested capital number, and are they investing that money wisely? And that plays a big part in knowing if their management team is doing a good job. So those are 3 things you should always look for when investing into a stock. Let me know what you guys think about this, and I will see you soon in the next video.